So there are a couple of stocks that I have been hunting for and taking starter positions in and looking at in much more detail lately. Now, while I think much of the market is overpriced, I think there are some small opportunities here and there. Now, a long time ago, I have talked about Teleperformance on the channel. It got a reasonable amount of interest. Now, I've finally started a position in this company in the last several weeks, and I'm looking to add to the position. Now, what am I looking at here? I'm looking at a company domiciled in France. It is essentially an outsourcing partner for your company. You have a whole load of operational requirements, call centers, etc. You can outsource a lot of the work to Teleperformance. They will do the work for you. One of the major concerns here has been the rise of AI and whether or not that will damage the opportunity for these types of outsourced companies to do the work. In my view, companies will still outsource. All that AI is going to do is going to make it easier and faster for Teleperformance to do the work so they can do it more efficiently, or they can pivot and enter new markets more efficiently. So I see it more as a gain for Teleperformance than a danger or a risk. Now, a couple of things I like here. At the current price, the dividend yield is 4%. That certainly wouldn't have been true a year or two ago. In 2021, we had a price to earnings ratio of about 37. Now we've got a price to earnings ratio of about 6 to 7 only. And we can see the written price in black here has been crashing down over the last several years. Meanwhile, though, the orange line representing the underlying adjusted earnings has been increasing and is projected to increase in the next several years. Now, if I look at the forecasting, I'm going to switch over to the normal multiple. So we can see here in black the price line. We can see here in blue the 5-year normal PE ratio. And I might try and switch that down to something a little bit more, or a little bit lower ultimately. So this is now the normal price to earnings multiple over the last 20 years. So reasonably, I think at 19 times price to earnings multiple with strong growth is a reasonable multiple to target. Now, there's a couple of things I want you to look at here, and one of the key points that attracts me is the way in which we have this very large growth here in the earnings. I'll explain more about this in an upcoming deep dive video on Teleperformance. But we can see also expected nearly double-digit earnings growth in 25 and 26. One of the challenges the company has had has been as I said, the AI, which has, I think, frightened a lot of investors. But here we can see that analysts' expectations have been relatively steady over the last 6 months. They haven't really decreased in a meaningful sense. And this isn't one or two analysts. This is about 14, 15 analysts as well reporting their expectations. Now, we did see at the end of 2023, there was a drop in the expected earnings. Again, I will cover that off in a deep dive later. Now, if the prices can take off from this point and they return to a sort of a 19 times price to earnings ratio by the end of 2026, we could be looking at an 84% annualized rate of return, which is primarily going to be driven by the price appreciation and the return to a 19 times price to earnings multiple from a 6 or 7 times price to earnings multiple. Yes, there is definitely downside to this company, but I don't believe that the downside warrants this type of price at the moment. As I said, we'll do a deep dive into this soon. Now, another company that I've been adding to in a very small position is Vici Properties. Now, this has a very strong experiential or a casino focus as a real estate investment trust. We'll see here that we're looking at the price to AFO ratio, which makes more sense when we're looking at REITs. Current dividend yield's about 5.5. Now I'm going to switch over to forecasting. Tack on the normal multiple of about 16 times over the last 5 years, which seems reasonable. A couple of notes here. We're looking at 2%, 3%, 4% AFFO growth in the coming years. So it has slowed down a little bit. But tack on to that the dividend yield, and we're looking at basically close to 10% annualized rates of return. A couple of other points here. The analyst estimates over the last 6 months have been fairly steady out for each one of the upcoming years. Again, we've got a reasonable number of analysts reporting, so I think we can take this as a reasonable expectation here. We can also see from the analyst scorecard that most of the time the analysts do a good job of estimating what these earnings, the adjusted funds from operation, are going to be. Now, again, if we have the earnings hold steady and price moves back to a 16 times price to earnings multiple, we're talking about an annualized rate of return of about 15%. Now, this is in very much the slow and steady and cash flow generating part of my portfolio. So I'm not trying to hit a home run here. That's really more for the stocks like Teleperformance that I'm looking at. Here with Vici Properties, I am simply putting money to work, earning a nice dividend yield in a company that I think has a lot of opportunities for slow and steady growth. Another company, this is one that I've been hunting, and I have been looking at this for a while, and I was attracted by this orange line here, which is the overall adjusted operating earnings. Now, a couple of months ago, this line was just shooting straight up in a fairly straight line, representing 10 to 20% earnings growth per annum. What a lot has changed. If we scroll down, we see that analysts generally find it easy to forecast the company earnings over 1 and 2 year, with most of the time they're able to estimate those company earnings ahead of time. Now, the dividend yield at the moment is 1.5%, so this is certainly by no means a dividend machine. However, if we look at the dividend being paid out, we can see that the dividend payout ratio has been decreasing, so I think there's lots of room here to increase those dividends. And in fact, if we look at the performance over time, we can see the dividend growth rate has been fairly strong many years. There's been a couple of years where the dividend growth rate was weaker, but fundamentally we're talking about a strong 10 to 20% dividend growth rate seems to be very achievable with this company. Again, I will go into a deep dive on this in a future video coming out soon. But what we're looking at here is some issues with the earnings. And we can see here from 6 months ago to today, there's been a sizable drop in the analysts' estimates of earnings for the 2024 financial year. And similarly, we can see some substantial drops for 2025 and also for 2026. Now, is this an opportunity? Is this a terrible investment? As I said, look, historically, the company and the managers have done a good job of growing the company's earnings. We can see here in orange that it's been a bit of a bum year for the earnings, and we haven't really seen that except down here in 2008. Now, what that has meant is the price has reacted very strongly here, and it's gone from about 16 times earnings down to now about 12.8 times earnings. Is it a good time to enter? If we look at the forecasting here and we take the normal multiple, if earnings grow as expected by the analysts and prices return to about a 16 times price to earnings ratio, which I think is very reasonable, we could be looking at a total annualized rate of return of 22%, which would be nice in the next several years. Now, take on top of that as well, the dividends should be increasing from about $6.50 a share to over $7 and almost 15 cents per share estimated by the analysts, representing quite a nice increase in the income from the dividends over this time period as well. Now, is this right for everybody? It's possibly not. There are obviously some interesting challenges and risks as we look at this change in the earnings this year, where the estimated earnings have just suddenly dropped quite a bit with renewed guidance from the management team. But I think this is quite a nice opportunity. As I've mentioned before, it's been an interesting several weeks and months. I haven't been online for about 2 months here looking and creating videos. But behind the scenes, I have still been tending to the finances for the family and our investments. And increasingly, particularly post election, I've been finding it hard to identify options that I think have a lot of value. Now, I've been putting some of the money to work, particularly also with a company called Eagle Point Income. It's a specialist investment manager and it focuses exclusively on CLO, collateralized lending, obligation securities, and related investments. Now, one of the nice things about this company is the investment approach is one that is focused on high current income. I'm not looking to generate capital appreciation here. Now, they focus on the junior debt tranches of CLO. Now, that means it's safer than equity ownership in CLOs, but it's not as secure as the senior debt tranches. So for me, it strikes a reasonable balance between the risks in the equity tranche and the potential for income that comes with the equity tranches compared to the more senior debt tranches. So for me, I like the risk reward ratio here. There's been a couple of reasons why the prices have been depressed in the last couple of months, which is one of the reasons why I've been picking up some more common stock in this company and taking my position up to basically where I want it to be at the moment to boost some of the higher current income. I've probably got it to where I want it, and I possibly won't be boosting it much further with Eagle Point Income. Now, do let me know what you think of these. Some picks here. We've got everything from high current income with Eagle Point through to very potentially turnaround stories almost, it looks like, with Teleperformance, Elevance with a slow, steady dividend growth stock, and Vici Properties as well with a reasonable dividend and some reasonable dividend growth opportunities here and a little bit of capital appreciation. So these are some of the options I've been looking at recently, taking some investment positions in and doing some very extensive research in others. Let me know what you think. Are these companies on your radar? If not, why not? Let me know in the comments down below, and I'll catch up with you soon.